Hello traders, and welcome back to lesson number 3 out of 4 on option Greeks. My name is Steve Ganz, and in this one we're going to cover gamma. So as we did previously, I'm going to go through the same intrinsic extrinsic. If you've watched the 2 prior videos, you've seen this. You can forward through it if you'd like. But in case someone sees this alone, this intrinsic extrinsic value is really key to know and understand. So intrinsic value is also called the moneyness of an option. You hear somebody describe an option as in the money, out of the money, at the money. An out of the money option has no intrinsic value at all. And we'll get into exactly what that means here in a second with a diagram that I think will help clarify that for you. Extrinsic value is the value of an option beyond its intrinsic value or its moneyness. It's made up mainly of 2 key components of time value and volatility. To give you an example, if I own a $100 call on XYZ stock and that stock is currently trading at 105, the intrinsic value of my call is $5. Now, the extrinsic value can vary with time and volatility. So, if I have this $100 call, we're trading at 105 and we're at expiration, there's no time left in this, my option is going to be worth $5 and all 5 of that is going to be intrinsic value. Now, if there is time left on this, if it is not yet at expiration, and we've got this same scenario, $100 call, trading, the market is currently at 105 on the underlying, I have the $5 of intrinsic value, but then I'll also have some value here that's extrinsic value that's left still in that trade. This is the amount that ultimately will decay out, but again, this is made up of time value and volatility are the 2 main components that come into play there. Now, to talk about the moneyness of an option, an out of the money option will have a market value less than the premium. This means that the option would not be profitable to exercise immediately. For example, if I own a call option that has a strike of $100 and the current stock price is at $90, that option would be out of the money because it would not be profitable to exercise the option and pay $100 a share for the stock that would then only be able to sell it for $90 a share. It just doesn't make sense. And in the money option will have a market value greater than their premium. This means that the option would be profitable to exercise immediately. For example, if a call option has a strike price of 100 and the current price of the underlying is at 110, the option would be in the money because it would be profitable to exercise that option and buy 100 shares of the stock at 100 and then sell them immediately for the 110. And of course, an at the money option means that your strike price is pretty much at the market value of the underlying at that time. So in that particular case, if your option has a strike price of 100, the current stock is trading at 100, the option is considered to be at the money and it wouldn't be profitable to exercise that option. There wouldn't be any reason to do so if those 2 things are equal. Now, another way of kind of quickly looking at this is if XYZ Corporation is trading at $100, a 110 call is out of the money. Of course, a 100 put or a call is at the money. A 110 put is in the money. So that will kind of help hopefully define that for you a little bit as well. Now, I want to get into gamma specifically. So gamma is one of the Greeks, which is a measure that helps describe the behavior of options. Specifically, gamma measures the rate of change of an option's delta. I know that sounds like you're talking a little bit in circles, but I think you'll see what I'm talking about here in a moment. Now, we've already covered delta and what delta means. So delta is essentially direction, and then gamma measures how quick delta is going to change in certain situations. So again, essentially gamma measures the rate of change of an option's delta as delta changes as the price of the underlying asset changes. Again, we'll see what all this means in a minute. I know it sounds a little peculiar right now. So gamma tells you how much the delta is expected to change for every $1 change in the price of the underlying asset. For example, if a call option has a delta of 50 and a gamma of 0.10, this means that the delta of the option is expected to increase by 0.10 for every dollar increase in the price of the underlying asset. I know, again, that's kind of a lot of double talk. I think when we get into the lab portion here using OptionStrat, it will become much clearer what all this means. It's a positive number for call options and negative number for put options, and you can see the reasons there. The delta of the put option decreases as the price of the underlying asset increases. Again, I know kind of a lot of weird words here, but we'll see the diagrams in a moment. It is a dynamic measure. It changes as the price of the underlying asset changes. This is because the delta of an option is affected by the price of the underlying asset, the strike price, timed expiration, volatility, etc. It's a useful tool for options traders because it can help them to manage their risk. If a trader's long a call option with a delta of 50 and a gamma of 0.10, this means that the profit will increase by 0.10 for every dollar increase in the price of the underlying asset. It's kind of a ratio sort of situation, and again, we'll see a diagram here shortly. And that will help a trader in determining kind of what their risk is in a move of the underlying asset. So in this particular case, I've got a butterfly. This is an iron butterfly, and this is in SPY. And we can see our T0 line here. Our T0 line is pretty darn flat. Now, again, if you think about gamma, gamma is how much our delta is going to change as the underlying price changes. Well, we can see that this line is pretty darn flat here. What that means is, if SPY sold off 5 points here, the amount of difference in my P&L is not going to be significantly different. Likewise, if the market went up, yeah, I'd be down a little bit, but there's not a big swing in this if I, drop 5 points, go up 5 points. However, this is, again, in a low gamma environment. When gamma's a little bit higher, our T0 line is mounted up a little bit more. Now, all of these diagrams here are going to show the same gamma because I'm using the same snapshot, but we're going to look at our table here in a moment, and you'll see how it actually changes. But the thing to note is how steep this curve is. In my mind, I think of gamma as, again, the steepness of this curve. In other words, is a $5 increase on the underlying going to have a big change in my P&L, or a small change in my P&L is another way of thinking of that. Something that would have high gamma is a position like this. And as positions near expiration, that's when the gamma gets the highest. You hear people talk about, I didn't want to take the gamma risk and carry it that close to expiration. This is what they're referring to. While you could be highly profitable in a trade like this, a 2-point move or a 5-point move will wipe out virtually all the profitability in a trade like that. So let's come in and take a look at a lab, and we'll kind of play with this a little bit. So as I mentioned, we come in here and we can see that if I drop from 501 and I go down to 494, okay, so that was a $25 change in price. Or if I go up to 506, it's about a $30 change in price. So not a significant change here while our gamma is nice and low. However, as we get later in the trade, our T0 line mounts up. Well, now if we drop 5 points and we get down to that 494, we go from a profit of 277 down to 170. Or we go from 277 to 140. So a fairly significant change in our P&L on that 5-point move. And then as we get really close to expiration, while we might have, if we are pegging this, if we're right in the center, while we might have higher P&Ls, again, we take that 5-point move and we go from 600 in profit to, 200 in profit roughly. Or we go from 600 in profit and we go up to 506, down to 250 in profit. So a small change impacts our P&L much more. That's that high gamma that we're talking about. Now, if I want to see this in a graphical mode, and again, this is one of the nice things about OptionStrat, is I can come in and I can specifically look at how gamma is going to play out over the life of my trade. And I start off, and gamma's pretty low here at 0.48. Now, as time goes on, gamma becomes a little more. And then as we get closer to expiration, gamma gets much, much higher. And again, we just need to remember that gamma is the steepness of this curve. In other words, how fast am I going to gain P&L if this goes in my favor, or lose P&L if this goes against me? So this is one of the reasons that many times you'll see delta neutral traders, and this is kind of the category that I tend to fall into. I'm looking to get my 10 to 15% out of a butterfly like this. I don't like to have to sit at my computer and day trade these things. I've been there, I've done that. And so I would rather be in a situation like this where I'm just sort of, if the market goes, down 20 points, up 20 points, whatever, I'm not going to sweat it. And when I say 10 or 20 points, usually I'm trading SPX. So let me rephrase that. If the market goes down 5 points or goes up 5 points, that is not going to be a major impact to this position. So if I'm out living my life, going on a bike ride, playing pickleball, whatever I'm doing, I don't have to sit there and stress about this. It's not going to make a big difference one way or the other. However, if I happen to be in this sort of position and the market is about where it is here today, I probably don't want to go away and leave this position because, again, a small move either direction can have a big impact in my P&L. So that's really what gamma is all about. Gamma is, the way I think of it, is essentially the steepness of this curve and how much move in the underlying is going to impact my P&L. That's really what gamma is all about right there. So if you are a trader that likes to be more active, you like to carry things closer to expiration, and you're fine with these sorts of swings, you can often get significantly higher returns out of a position, but they require more attention. I should also point out that your people that are trading 0 DTE, the people that are entering a trade today, for example. Let's just take a look. I mean, if you go and enter a trade like this, you're almost starting off, at high gamma. Where if you enter a trade that's out 90 days, you're starting off very flat gamma. Actually, let me change this back. You're extremely flat in your gamma. So hopefully that helps people in understanding kind of how gamma impacts your positions, which is ultimately what you need to understand as an options trader. So with that, everyone, we're going to move into the final session on Vega or volatility, and I will see you there. So take care.